Imagine setting up this massive multi-million peso trust fund for your kid. You've done the math, you've hired the lawyers, and you've specifically structured it to, escape the highest tax bracket.
Oh, yeah, the classic wealth preservation move.
Exactly. You think you've completely outsmarted the system, only for the Bureau of Internal Revenue to see right through your stack of paperwork, ignore your clever setup, and just hand you the massive tax bill anyway.
It happens way more often than you'd think. I mean, the lawmakers who wrote the tax code were, well, they were incredibly paranoid about wealthy individuals using legal entities to hide their money.
Right.
And so they built these really specific traps to catch them.
Which is exactly what we are dissecting today. So, if you are tuning into ICPA Review Radio, maybe grabbing some study time on your commute or at your desk, we are tackling a notoriously tricky area for the board exam.
Oh, definitely tricky.
Yeah, the taxation of estates and trusts. Specifically, we are doing a deep dive into sections 60 through 66 of the National Internal Revenue Code.
Right, the NIRC.
And our mission today isn't just to mechanically memorize these rules. We want to understand the absolute paranoia of the lawmakers who wrote them. Because once you understand what the BIR is afraid of, you can anticipate every single trap the examiners will set for you on test day.
That is honestly the perfect way to frame it. Because usually taxation feels like simple geometry, right?
Right. You earn a salary, look at tax table, pay the state.
Exactly. But trusts and estates introduce this murky third party. You've got the person who created the wealth, the entity holding the wealth, and then the person eventually receiving it.
It gets crowded.
It really does. And the BIR's entire goal across these sections is just to figure out which one of those three should be stuck with the tax bill.
So let's break down the landscape here. Under Section 60, subsection A, who is the BIR targeting first?
Yeah.
What's the default?
So the default rule is that the trust or the estate pays. Section 60 establishes that the tax imposed on individuals also applies to the income of estates or property held in trust.
Okay, so they essentially treat the trust like a living, breathing person.
Yeah, pretty much. And this covers a few scenarios you'll definitely see in multiple choice questions. For instance, income accumulated for unborn or unascertained persons.
Because if the beneficiary doesn't exist yet, somebody still has to pay.
Exactly. So the trust pays. It also covers income distributed currently by a fiduciary or, estate income during the administration of a deceased person's affairs.
I got it. And discretionary income.
Yeah, discretionary income too, where the trustee gets to decide whether to hold the money or hand it out.
I actually want to pause on that because right away in Section 60B, the code throws this massive exception at us. And we know examiners love exceptions.
They live for exceptions.
They really do. So what if an employer sets up, say, a pension or a profit-sharing trust for their team? Is that corporate trust taxed the exact same way as some wealthy family's private trust?
It is not. And that is a highly testable area for the board. Employee trusts are explicitly exempt from this tax, provided they meet two very strict conditions.
Okay, what's the first one?
First, the contributions have to be made by the employer, the employees, or both, for the sole purpose of distributing the earnings in principle back to the employees.
So it has to be a genuine benefit plan. It can't just be some, corporate slush fund.
Correct. Which leads us directly to the second condition. The trust instrument must make it legally impossible to divert those funds to any non-employee purpose.
Right, before all the employee liabilities are satisfied.
Exactly. The employer cannot just raid the pension fund to, say, pay off a bad corporate loan.
Okay, let's visualize this for the listener because I think it helps. Think of the employee trust as a financial incubator. It's the sealed, tax-free environment.
That's a great way to look at it.
Right. So while the employees' and employers' contributions just sit inside that incubator, growing, compounding, earning interest in the stock market, the trust isn't paying a single cent of income tax on those earnings.
Not a cent.
But incubators have to open eventually. What happens when the employee retires and finally harvests that payout?
Well, that is precisely where the examiners will try to catch you. Because the trust is exempt, yes, but the individual employee is not.
Oh, so the BIR still gets their cut.
Oh, always. Any amount actually distributed to the employee becomes taxable to them in the year it's distributed. But, and here's the catch, they only pay tax to the extent that the distribution exceeds the amount the employee originally contributed.
Let's actually walk through that computationally, because you are guaranteed to see this in a problem-solving scenario.
Definitely.
Well, okay, imagine you are the employee. Over your career, you contribute 50,000 pesos from your own salary into this trust.
Okay, 50,000.
And your employer matches it with a 100,000 peso contribution. The investments perform beautifully inside our little tax-free incubator, and when you retire, you receive a lump sum payout of 250,000 pesos.
Okay, so the exam is going to offer you several tempting answers here. They might try to tax the entire 250,000 payout.
Which feels wrong.
It is wrong. They might also try to tax only the employer's 100,000 contribution. But you have to look at the underlying logic. You put in 50,000 pesos of your own money.
Right, and that was deducted from my paycheck, meaning it was already taxed years ago.
Exactly. The BIR isn't going to tax you on your own principal again. That would be double taxation.
Okay, so we take the total payout of 250,000, we back out your original 50,000 contribution, and your taxable amount is 200,000 pesos.
You got it. So the formula to lock in your mind is total received minus employee's own contribution equals taxable income.
And if you think about why that 200,000 is taxed, it represents two things, right? The investment growth of the fund and the employer's contributions.
Which is essentially deferred compensation. You didn't pay tax on it when they put it in, so, well, you have to pay tax on it when you take it out.
That makes the mechanic so much clearer. Now, I want to move to Section 60C and put myself in the shoes of a tax lawyer trying to, break the system.
Oh, here we go.
Well, we established that a trust is taxed like an individual. And the Philippines uses a progressive tax system, meaning the more you earn, the higher your tax bracket.
Right.
So if I'm a wealthy grantor setting up a trust for my son, and I know this trust will generate, say, 50 million pesos in income, that trust is going to hit the maximum tax bracket instantly.
Yes.
Why wouldn't I just create 10 separate trusts, funnel 5 million pesos into each one, and ensure every single trust gets taxed at a much lower, friendlier bracket? I mean, it's the same money, same kid, but a fraction of the tax liability.
And that right there is the exact loophole that keeps lawmakers awake at night. You are trying to fragment your wealth to artificially depress your tax bracket.
But the code catches it, right?
It does. Section 60C2 anticipates this maneuver and shuts it down through what we call the consolidation rule. I always tell reviewees to use a really simple memory aid for this, the double S rule.
The double S rule. Okay, I'm writing that down in my notes right now. How does it work?
You trigger the consolidation rule if there is the same creator and the same beneficiary across two or more trusts.
Double S. Same creator, same beneficiary.
Exactly. If you see that combination in a problem, the BIR doesn't care if you drafted 10 different trust documents with 10 different lawyers. For tax computation purposes, they fuse them all together into one giant entity.
Okay, let's play out the computation for that, because knowing the rule is only half the battle on the board exam.
True.
Let's say you are the trustee for Trust A, and I am the trustee for Trust B. It's a double S scenario. Same wealthy creator, same lucky beneficiary. My trust earned 2 million pesos, and yours earned 8 million pesos. How do we actually calculate who pays what to the BIR?
Okay, step one is to combine the taxable income of all the trusts involved. So we take your 2 million and my 8 million, giving us a consolidated taxable income of 10 million pesos.
Okay, total 10 million.
Step two, we compute the total income tax on that single 10 million peso figure. By stacking the income, we force it back into the higher, correct tax bracket that the grantor was trying to evade in the first place.
Okay, let's assume the total tax on that 10 million comes out to 3 million pesos. Do you and I just split that bill 50-50?
We do not, because that wouldn't be equitable to your trust, which earns significantly less.
Right. I only made 2 million.
Exactly. So step three is apportionment. You calculate what percentage of the consolidated income belongs to each specific trust. Your trust generated 20% of the total 10 million.
So I pay 20% of the tax.
Yes, you pay exactly 20% of the consolidated 3 million peso tax bill. My trust generated 80% of the income, so I carry 80% of the tax burden.
That is incredibly elegant. Combine the income, calculate the total tax at the higher bracket, and then allocate the pain proportionately based on income share.
Nicely summarized.
Okay, so that solves the problem of multiple trusts. But Section 61 gets into how we compute the taxable income in the first place, specifically regarding deductions. And this introduces the concept of the trust acting as a conduit.
Yeah, the flow-through concept. Section 61A and B recognize that a trust doesn't always just hoard the money.
Sometimes it's just a temporary holding cell before the funds pass to the real owner.
Precisely. If the fiduciary distributes income currently to the beneficiaries, or, if an estate properly pays or credits income to an heir during the administration period, the trust is allowed to claim that exact amount as a deduction from its gross income.
Which is completely logical. They shouldn't pay tax on money they no longer possess. But wait, if the trust takes a deduction, the BIR is suddenly missing tax revenue. They aren't going to just let that money vanish into the ether, are they?
They absolutely will not. And this brings us to the ironclad rule of trust taxation. Think of it as a rigid seesaw on a playground.
A seesaw, okay.
One side of the seesaw is the trust's taxable income. The other side is the beneficiary's taxable income. The BIR mandates a strict matching principle.
So if one side goes down,
The other side must go up. If the trust side goes down because they claimed a deduction for distribution, the beneficiary side must immediately go up. The beneficiary has to include that exact amount in their personal taxable income.
so it's a perfectly closed system. The BIR doesn't care which side of the seesaw is weighed down, as long as the total weight of the tax is accounted for. There are absolutely no double deductions allowed.
None.
But let me push back on the wording you just used. You mentioned money being credited to an heir. What if the money hasn't actually touched the beneficiary's hands yet? Like, what if it's just sitting in an account in their name?
Constructive receipt applies here.
I knew it.
Yep. The law specifically states it must be included by the beneficiary, whether it was actually distributed to them or simply credited to them. If you have the legal right to the money and it has been set aside for you, you are paying tax on it.
Regardless of whether you physically cashed the check.
Exactly.
Now, reading through the source text, I found a fascinating outlier in Section 61C that I guarantee examiners will mine for tricky true-false questions. What happens to our seesaw if the trust is administered in a foreign country?
This is where we have to look at the mechanics of international tax jurisdiction. The BIR has, well, immense power within the Philippines, but they cannot easily audit a trust managed in Zurich or the Cayman Islands.
Yeah, that makes sense.
Because they cannot verify the activities or enforce collections on a foreign trust, Section 61C explicitly states that a foreign trust cannot claim those deductions for distributions.
Wait, if the foreign trust is denied the deduction, their side of the seesaw stays high.
Right.
Does that mean the local beneficiary's side also goes high? Like, does the foreign trust pay tax on the income? ND, the local beneficiary pays tax on it when they receive it.
If the law allowed that, it would be a brutal case of double taxation. But the code actually provides a brilliant relief valve here. The matching principle works in reverse to protect the taxpayer.
Oh, really?
Yeah, because the foreign trust was not allowed the deduction, the beneficiary in the Philippines is not required to include that income in their personal tax return.
Oh, that is a fantastic mechanism. The BIR basically says, we don't trust the foreign entity, so we are taxing the money there before it leaves if we can, but we won't punish the local citizen for it.
Precisely.
So for your exam notes, foreign trust equals no deduction for the trust, which equals no taxable inclusion for the local beneficiary.
That's the formula. And just as a quick administrative note for everyone reviewing, Section 62, which deals with specific exemption amounts for estates and trusts, was amended by the Train Law, Republic Act 19963.
Right. The train law changed a lot of the baseline numbers.
It did. So while we are focusing purely on the mechanical rules of the code in this deep dive, ensure your broader studies incorporate those updated exemption rates.
Always check your updates.
All right, so we've covered scenarios where the trust pays and where the beneficiary pays, but the theme of this whole discussion has really been about control.
It always comes down to control.
Right. So is there ever a scenario where the creator of the trust, the grantor who supposedly gave the money away, gets stuck with the tax bill? Examiners test this rigorously because it strikes at the heart of substance over form. This is found in Sections 63 and 64. Revocable trusts and income for the benefit of the grantor.
Okay, so what's the philosophy there?
It's simple. If you create a trust, but keep a tight leash on the money, or, if the trust exists solely to pay your personal expenses, the BIR will declare the trust a sham for tax purposes.
We'll just look right past the entity.
Exactly. They will look right past it and tax you, the grantor, directly. I actually like to use a three-part test for this.
Let me guess, based on the sections, does this have to do with whether the grantor can get the money back, keep the income, or pay their insurance?
You are tracking exactly with the law. We call it the RIP test.
The RAP test. Rest in peace. Let's explore that mechanically. The R would stand for revert, referencing Section 63.
Correct.
So if the grantor retains the power to revert the corpus-like, the main body of the trust back to themselves, they haven't really given the property away. It's just a temporary parking spot. So they pay the tax.
Nailed it. The I stands for income, referencing Section 64. If the income of the trust is being held or accumulated for future distribution to the grantor, it is essentially a glorified piggy bank.
Right, because the grantor is the true economic beneficiary, so the grantor pays the tax.
Exactly. And finally, the P stands for premiums.
Meaning, if the trust's income is applied to pay the premiums on the grantor's life insurance policies.
Yeah. In that case, the trust is just acting as their personal accountant, paying their bills.
So we have revert income premiums, RIPP. If any of those conditions exist, the trust rests in peace as a tax entity and the grantor foots the bill.
That's it.
I want to dig into the legal phrasing here, though, because the code adds a really fascinating condition. It says the grantor pays if these powers are in the discretion of the grantor, quote, either alone or in conjunction with any person not having a substantial adverse interest.
Oh, that is a mouthful of legalese.
It really is. Let's break down substantial adverse interest. What does that actually mean?
It is the most crucial distinction in the grantor rules. Let's put you in a scenario. You create a revocable trust, and you name your brother as the sole beneficiary.
Okay, my brother gets everything.
Right. But you put a clause in the document that says, I, the grantor, can revoke this trust and take all the money back, but only if my brother gives his official consent.
Well, if my brother consents, he loses his entire inheritance. It is entirely against his financial interest to let me take the money back.
Exactly. Which means your brother has a substantial adverse interest in the revocation. Because you need the permission of someone who would suffer financial harm, the BIR recognizes that a real tension of power exists.
Like, I don't have absolute, unchecked control.
Right. Therefore, the law respects the trust, and you are not taxed as the grantor.
But let's change the scenario. What if the clause says, I can revoke this trust and take the money back, but only if my best friend, who is not a beneficiary and has nothing to do with this trust, gives his consent?
Well, your best friend doesn't lose a single cent if you revoke the trust. They suffer absolutely no financial harm.
So they have no substantial adverse interest.
Exactly. The BIR views that as a hollow hurdle. They assume your best friend will just do whatever you ask. So in that case, the RAP test is triggered. The law views you as having full control, and you, the grantor, are paying the tax.
That is brilliant. The BIR is hunting for real economic independence, not just paper speed bumps. If you hold the control, you hold the tax liability.
Spot on.
All right, as we head into the final stretch of our review, let's pivot to the administrative realities. Sections 65 and 66. These administrative rules are notorious for hiding in true, false, or Roman numeral questions on the exam. Let's look at filing requirements first.
Sure. Section 65 covers fiduciary returns. Basically, if you are appointed as a guardian, a trustee, an executor, or an administrator, the burden of filing the return of income to the estate or trust falls on you.
What are the specific data points our listeners need to highlight in their review materials for that?
3 things. First, the return must be rendered in duplicate. Second, it must be under oath, meaning you legally swear you have sufficient knowledge of the affairs to make a true return.
Okay, duplicate, under oath. And the third?
The third is the filing threshold. You must file if the gross income of the estate or trust is 20,000 pesos or over during the taxable year.
20,000 pesos. That seems like an incredibly low threshold for a trust. Why did lawmakers set it there?
They want to cast the widest net possible. For the government, the administrative burden on the taxpayer is secondary to the state's desire to track wealth movement.
That makes sense.
But they do offer one administrative simplification. If a wealthy family trust has 3 joint fiduciaries, say 3 siblings living in different provinces across the Philippines, they don't all need to file.
Oh, because that would be a logistical nightmare.
Exactly. Section 65 states that a return made by one of 2 or more joint fiduciaries is sufficient compliance. The fiduciary who takes responsibility simply files it in the province where they reside.
Let me put you in a hypothetical situation based on Section 66, because this is where the theory hits reality.
Okay, let's hear it.
Imagine you are the trustee. You've done the math, you've filed the duplicate return under oath, and you've paid a massive tax bill out of the trust's funds.
Right.
The beneficiary, who is expecting a much larger payout, is furious. They hire a lawyer and sue you, claiming you squandered their inheritance but giving it to the BIR, and they demand you reimburse the trust out of your own personal bank account.
It's a very real fear for anyone acting as an executor or trustee. People get very emotional about inheritances.
Right.
But the tax code anticipates this and provides an absolute shield. Under Section 66, fiduciaries are fully indemnified against the claims or demands of every beneficiary for all payments of taxes they are required to make.
So the state essentially says, you acted as our tax collector, we will not let you be punished for it.
That's exactly it. The law explicitly states that the fiduciary gets full credit for the amount of those tax payments against the beneficiary or the principal in any accounting they make.
Oh, wow.
Yeah, so when you show the books to the angry heirs, taxes paid to the state is a legally protected line item.
Right.
You will never be forced to pay out of pocket for executing your legal duty to the government.
That is a phenomenal safety net, and honestly, a great way to close out our analysis. You have absorbed a massive amount of technical material today, so let's lock it into your short-term memory.
Let's do it.
Here is your high-energy, rapid-fire exam day checklist. 4 mechanisms you absolutely must remember when you sit down for the tax portion of the board exam. Number 1, employee trusts. Yes, the incubator is exempt, but watch out for the distribution trap. The payout is taxable to the employee, but only to the extent it exceeds what the employee originally contributed out of their own pocket.
And number 2, consolidation. Keep the double S rule ready. If you spot the same creator and the same beneficiary across multiple trusts, the BIR combines them. You consolidate the income, compute the tax at the higher bracket, and apportion the liability based on each trust's percentage of the total income.
Number 3, deductions and the seesaw. Remember the matching principle. If the trust is allowed a deduction for distributing or crediting income, that exact amount becomes taxable income for the beneficiary. No double deductions allowed. And remember, the outlier foreign trusts don't get the deduction, so local beneficiaries don't face the inclusion.
And finally, number 4, the grantor tax. Run the RIP test. Revert income premiums. If the creator has the power to pull the money back, hoard the income for themselves, or use it to pay their life insurance premiums without the consent of someone with a substantial adverse interest, the trust is ignored. The grantor pays the tax.
We started the session talking about how the rules for estates and trusts feel murky, like the lawmakers are just throwing darts at a board. But I hope you see now that there is a terrifyingly logical engine driving all of this.
And that engine is control. As you continue your CPA review, whether you are tackling trusts, dissecting corporate dividends, or looking at individual tax rates, always stop and ask yourself in this transaction, who truly holds the economic power? Who truly benefits?
Because that is exactly where the examiner and the BIR will look to collect the tax. Look for the control, and you will find the right answer.
Absolutely.
You've got this. Good luck on your review grind. Stay confident, stay focused, and we'll see you on the next deep dive.